Stepping into the world of life insurance can feel like walking through a maze blindfolded. There are so many terms, options, and questions. Do I really need it? What kind is right for me? When should I purchase it? And how do I make the right choice? If these questions sound familiar, you are in the right place. In today's video, I will guide you through what you need to know to make the best decision for you and your loved ones. I will explain what life insurance is and who needs it, and I will go over the different types of insurance policies, including which one you should avoid. Well, what exactly is life insurance? At its core, life insurance is a contract between you and an insurance company. You agree to pay them a certain amount monthly or annually, known as a premium. And in exchange, if something were to happen to you within the term specified in the contract, the insurance company commits to paying a significant sum of money known as the death benefit to the individuals you designate as your beneficiaries. Often, the beneficiaries are family members, but here's a fun fact. You can also name yourself as the beneficiary. In this case, if something happens to you, the proceeds become part of your estate and are distributed according to your will. Additionally, most life insurance policies offer extra features or riders which provide benefits that can be used while you're still alive. A common example is critical illness coverage, which is a rider that allows you to access a portion of your death benefit if you are diagnosed with a specified critical illness, such as cancer, a heart attack, or a stroke. Once access to the money is approved, it can be used for any expenses you face during your treatment, not just for medical costs. Who needs life insurance? Purchasing life insurance is recommended if you are raising a family and have children who rely on your income for their daily needs and education. If you are in a relationship where your partner depends on your income to cover joint responsibilities like mortgage payments, loans, and daily expenses. If you have significant debts, especially those co-signed with others like student loans, in the event of your passing, these obligations could become a financial burden to your co-signers, such as parents or partners. If someone depends on you financially, like an elderly parent or a family member with a disability, you should consider what their situation would be if you were no longer around to support them. If you are a business owner, having life insurance could be beneficial because it can provide funds to keep the business running, buy out your interests, or support your family financially during the transition period. And even if you are young, single, and starting your financial journey, purchasing life insurance could be a good idea because it will not only cover expenses and outstanding debts if something unexpected happens, but with riders like the critical illness coverage I mentioned, you are also protected in case, knock on wood, something very serious happens, allowing you to focus on recovery without financial stress. Not to mention that the best time to buy life insurance is when you are young and healthy because premiums are more affordable and it's easier to qualify for coverage. The rate you secure your monthly premium remains fixed, so you can lock in that amount until the policy ends. Now, it may seem like everyone needs life insurance, but that is not really the case. As you get older, the need for life insurance decreases because you are likely to have fewer dependents, you will pay off debts, and as time passes and income is earned, the income can be employed to meet your financial goals, allowing you to rely less on life insurance. So overall, purchasing life insurance is an essential step in financial planning, especially during your working years, because that is when you have the highest amounts of debts and financial obligations. Speaking of working years, many people have access to life insurance at work. However, that is a great benefit as long as you remain employed, because if you change jobs or are laid off, you lose your insurance coverage. So perhaps if that is your case, you might consider purchasing life insurance outside your employment situation. How much life insurance should you aim for? A general rule of thumb is to target 10 to 12 times your annual income. For instance, if you earn $50,000 annually, starting with a baseline of $500,000 to $600,000 in coverage is a good starting point. However, feel free to adjust as needed to address any specific financial concerns or obligations you may have. Now, moving on to the types of insurance policies. There are essentially two kinds: term life insurance and permanent life insurance. Let's dive into term life insurance first. Term life insurance is a policy designed to protect you for a specified time frame. This could be 10, 20, or 30 years. If the term ends and you're still around, which is what we all hope for, the policy doesn't pay out the death benefit. And just to clarify, you won't get back the premiums you have paid. Just think about how other insurance works. Take a car insurance, for example. It expires every year. If you don't use it, you don't see any return on what you have paid. And once the term is over, it's over. You can decide whether to renew the policy or just let it go. Now, the right length of coverage you should get is a highly personal decision. However, a good rule of thumb is to match it with your most financially vulnerable periods, like until your children are grown-ups and on their own, or until your mortgage is squared away, or until you have reached a certain level of financial stability. Let's take someone with my profile as an example. I am married, but I don't have debts, I don't have a mortgage or children, and no family members currently depending on me financially. However, the future could bring kids and dependents who will rely on me, so I could take advantage of my current age and health to secure a lower rate on a 20-year term life insurance for the vulnerable period that I foresee coming. And if needed, I can always purchase a longer policy down the line. Oh, and by the way, term policies are generally not available beyond age 75. But then again, the general rule is that your need for life insurance tends to diminish as you get older. Cost-wise, term life insurance is very affordable and can fit into nearly any budget. Of course, rates will vary based on age, health, smoking status, gender, and whether you participate in extreme sports or if you have a job that exposes you to danger. But on average, a healthy 30-year-old might secure a 20-year term life insurance policy with a $500,000 benefit for around $25 per month. The cost benefit is incredible because it is budget-friendly, simple, and straightforward. So I will do you a favor and I will drop a link below where you can check out average costs based on your age, gender, and coverage amount. Moving on to the second type, which is permanent life insurance. Here's the essential rundown. This category encompasses several policies such as whole life insurance, universal, variable, and index life insurance, each type offering you lifelong coverage as long as you keep up with the premiums, of course, which, by the way, have a fixed cost and do not increase over time. However, the promise of lifelong insurance isn't its only feature. Essentially, when you pay your premium on a permanent life insurance policy, a portion covers the insurance cost, the death benefit, and another portion is directed into a cash value account. This account serves as a saving component that accumulates value over the life of the policy. So basically, you're getting a 2-for-1 deal, an insurance policy plus an investment account. Another significant selling point of permanent life insurance is that the cash value grows on a tax-deferred basis, meaning you won't pay taxes on the interest, dividends, or capital gains while they accumulate. And depending on the policy, they even guarantee what the minimum growth rate of the cash value will be. In other words, they promise that your money will grow at an X rate even if the actual stock market is not performing well. In fact, sometimes we see permanent life insurance being advertised as a tax-free retirement planning tool, based on the idea that you can use these funds to supplement your income during retirement. Oh, and not to mention that some types of permanent life insurance may pay dividends to policyholders. These dividends can be used to reduce premiums, to increase the cash value, or to increase the death benefit depending on the policyholder's choice. Does it sound too good to be true? It's because it is. Permanent life insurance is a joke. It's a disservice, and I will explain why. Yes, you will be signing a contract that will entitle you to have lifelong insurance with a fixed premium that will not increase over time. But a fixed premium is only possible because this type of insurance is pricey. Most people cannot afford it over the long term. For instance, a healthy 30-year-old can expect to pay $500 a month for a $500,000 policy, and that's just the starting point. I have heard of people paying $700 to $1,000 monthly. However, signing up for lifelong insurance isn't really the problem, even though as you get older, the tendency is to not need this type of protection. The problem arises when you mix insurance with investing and it becomes this hybrid nonsense. So let's uncover what the real deal is with the cash value account, starting with the return on your investment. Despite their promises and simulations on how well your money could perform, expect the real return to be below the actual performance of the market, period. Why? Because of fees. This type of policy has commission, administrative, and premium charges that will all eat into your potential gains, leaving you with a modest 2 to 4% return depending on the policy. If you think about it, this is a long-term commitment, and for long-term investments, a 2% return is a joke. You can achieve far better results through more direct investment strategies like investing in low-cost index funds through a Roth IRA or a 401k. Assessing your funds in the account is also another problem. If you withdraw your money before a specified period in the contract, which is usually 10 years, or try to cancel the policy, you will be hit with a surrender charge. A surrender charge is a fee the insurance agency imposes if you disrupt the policy because the cost of issuing it, including paying commissions and administrative expenses, are very high. So they want to make sure that you won't withdraw the funds during the first years because they need that money to cover expenses. What about the tax-free characteristics of these policies and the idea behind using them to supplement retirement? Here's what they do not tell you. The only way to avoid income tax consequences is by borrowing from your money. That's right. If you want to access the funds without paying tax, you will need to take out loans, even though those funds are yours. And the logic behind it is that loans are a type of debt and debt is not taxable. However, these loans are also not free. The insurance agency will charge you interest rates, and if you fail to pay back your debt, the amount will be deducted from the death benefit. The other way to access your money is by withdrawing it. However, here's the catch. Your cash value is composed of your contributions and the earnings of these contributions. If you would like to supplement your retirement or use this money for something else, you can withdraw tax-free only the amount you have contributed. Once your withdrawals exceed the amount you contributed, it will then be coming from the earnings and will be taxable as ordinary income. For instance, imagine you have paid your premiums consistently and the sum of your contributions is $200,000, and in your cash value account you have $340,000 available. The $200,000 is yours and it is not taxable because you have already paid taxes on them before it entered your account. But the $140,000, which is the return on your investment, will be taxed. Therefore, if you are seeking a tax-free income during retirement, the best option is to stick with Roth retirement accounts, which are designed specifically for those who have this goal in mind. And the best of all is that they are simple and accessible. Moving on, there is a type of permanent life insurance called whole life policies, which are mostly offered by mutual insurance companies. In a mutual insurance company, there are no external shareholders. Instead, the policy holders themselves are the owners. So when you buy a policy from a mutual insurance company, you essentially become a part owner of the company. Now, they love to brag that unlike stocks that distribute profits to shareholders, they are different. They distribute their profits to their policyholders in the form of dividends. However, this is all BS. Think of it from this perspective. As a policyholder, you are the customer. For these agencies to have a surplus in profits, it means that you have to overpay for their services. Therefore, those dividends are essentially them giving you your money back. And you know what? Not even the IRS recognizes these payments as dividends. They classify it as a return of overpaid premiums. So if I were you, I would stay away from mutual insurance companies. And finally, the cherry on top of the cake is that with permanent life insurance, if you pass away without withdrawing your funds from your cash value account, your beneficiary will only receive the death benefit. If the payout on the policy is $500,000, then $500,000 is all they get. Who will get to keep your cash value? The insurance agency. There are so many reasons why this product is flawed, and it will be impossible for me to debunk everything in a short video without overwhelming you. So my purpose here today is that you walk away with two things in mind. Number one, if you need investment help because you lack the knowledge or find it challenging to manage on your own, speak to a financial advisor, not an insurance consultant. An insurance agent selling permanent policies earns a significant commission on that sale, and discussing how to invest your hard-earned money with them isn't wise. Number two, life insurance has one job: to replace your income when you're gone. And for that, a term policy is enough. I hope this video was helpful. Thanks for watching, and see you next time.